All right. Well, good evening, everyone. I think we're going to go ahead and get started here at 7:01. I'd like to welcome members of both the Ontario Association of General Surgeons and the Canadian Association of General Surgeons, as well as our guest speakers from MD Financial Management this evening. Thank you all for joining us tonight. I hope everyone has been staying safe and healthy over the past few months. My name is Tim Jackson. I'm the current president of the Ontario Association of General Surgeons, and I work at University Health Network in Toronto. It's great to see the COVID numbers going down, but unfortunately so have many of our finances, given the impact the pandemic has had on our surgical practices. So on that note, OAGS is very pleased to have this opportunity to be partnering with CAGS this evening in order to bring this financial webinar to both OAGS and CAGS members. It will be presented to you by the team from MD Financial Management. So at this point, I'll hand over to our Canadian Association of General Surgeons Secretary and Treasurer, Dr. Brent Zabolotny. Hopefully I got that right, Brent, and he's going to introduce himself and the team. Thanks so much.
All right, thanks. It's impressive that you could pronounce my name that well, so thank you very much for that. As Tim mentioned, I'm the Secretary Treasurer on the executive at the Canadian Association of General Surgeons, and I really want to take this moment to thank everybody who came together to make this webinar possible. OAGS for their organization efforts, and in particular MD Financial Management for coming together to do this for us. Members have been polled lately as to what they'd like to see in terms of information. This was a very hot topic. So very much thank you to MD Financial Management for supporting us in this. We have 3 speakers on our panel tonight. I'd like to introduce them and then we'll get started. Jean-Francois Bordelot, known as JF to his friends. He's a veteran of the investment industry with over 25 years of experience. He works primarily as an information conduit for advisors and oversees investment training, products, and services. We also have Kim Peterson with us tonight. Kim is a senior financial consultant with MD Management, and she has almost 20 years of experience in the financial services industry. She specializes in developing customized financial plans and helping her physician clients and their families achieve their financial goals. And then finally, we have Jennifer Poon. And she works as the Director for Advanced Planning at Scotiabank and oversees national tax support for advisors and relationship managers, as well as leads in business and family advisory services. Her role is also acting as the leading subject matter expert for wealth management taxation. So welcome to our panelists and our speakers. Thank you very much for giving up your evening to share your expertise and knowledge with us. And now I'll turn things over to Lee Rato, MD Management's Regional Vice President.
Hello, everyone. We're glad that you could join us this evening. These are certainly unprecedented times for the medical community, and for that, we wanted to thank you and your colleagues. We understand that these are challenging times, impacting all of you in different ways, and whether you're on the front lines or you have seen a significant reduction in practice, we are here to help you navigate through what is available to help you with your financial impacts. So I am your moderator, Lee Rato, also mentioned as Regional Vice President, actually Prairie Region based out of Winnipeg. I'm joined today by my colleagues Kim Peterson, who was introduced, JF, and Jennifer Poon from Scotia Wealth Management. So we do have a lot of content to cover. Our goal is to get through this presentation in about 45 minutes, and then to answer questions during the last 15 minutes of our hour together. So please submit your questions via chat during the webinar. We will do our best to answer as many questions as possible at the end of our session. The ones that we don't get to, we will certainly make sure that we get back in touch and make sure that you get the answers you're looking for. We will also be starting off with some polls as just a nice way to see how everyone's feeling, and we'll aim to address some of these thoughts that you submit in the polls as we go throughout the presentation today. So we're going to start with our first poll just on who we have on the call. So if you can take we'll probably take 20, 30 seconds here just to register who you are. We will leave that as our first poll. Okay, we'll give it a few more seconds and I will close that out and share it. All right, we're closing that one out. And you should see the results. And I will pull up our second poll. I am trying to pull up our second poll. Okay. Here is the second poll, and I will launch that right now. Apologize for the technical glitch there. So we'd like to hear from you on what your biggest concerns are when it comes to the current COVID-19 situation. So please go and log your votes now. And again, it's really interesting that what we'll try to do is, based on the responses to these polls, we'll try to integrate that into our thoughts as we go through the presentation. All right, last few seconds to get your votes in. And I will close this one out and share. I do like the 7%. My kids are home all the time. That's a good thing or a bad thing, depending on your kids. All right, and the last question that I will launch is, what is your biggest concern when it comes to your finances during this time? So please log your answer to this poll. All right, that's great. We had more than 80% of people vote. So thank you everyone for putting in your vote. As mentioned, we'll touch on some of these feelings throughout our discussion tonight. So why don't we look now to pass it on to Jennifer to get us started. Jennifer, over to you.
Thank you, Lee. And thank you to our partners tonight. I'm very happy to be here. As Dr. Jackson and I were chatting earlier, I do have 4 doctors as neighbors and a surgical nurse as neighbors. So this becomes some of the programs we're about to discuss become some of our very common topic during social distancing happy hour. And so hopefully you'll find this useful. And also, I wanted to preface everything with the way the presentation is set up is we have business measures and then we have individual programs. And the reason why I set up this way, and I want you to think, I know many of our members are likely incorporated. You have a medical professional corporation. When we go into a business measure, it's really as relate to you as a shareholder, you as a business owner, you as an employer. You'll notice a lot of these programs do not have, are based on payroll. So you'll need a payroll to, you need a payroll number to be able to, perfect, I just got control, to be able to apply for some of these programs. So starting with the business measure, the most popular one that you might be wondering about is the CEWS. It's a Canada Emergency Wage Subsidy. So in about 3 slides, we're going to talk about the other subsidy, the temporary wage subsidy. So the reason why the CEWS and on an individual level, the CERB, the Canada Emergency Response Benefit, are the most popular among our clients is this is actually a check in your pocket. As a medical professional corporation, if you have employees, you can get up to $847 per employee from the federal government to help you to keep the employee on the payroll during this time. So what is eligible is 75% of your wages, and it's eligible to eligible employer, which generally is the a corporation, a partnership, and or a not-for-profit or a charity. The restrictions around this is if the employee is already getting the personal benefit, the CERB, you can't, as an employer, claim this wage subsidy on the same employee. And the employee has to be employed in Canada and have remuneration, you've paid them a wage of some sort for 14 consecutive days during this period. As an employer, just trying to advance to the next slide. As an employer, you should be an individual, a taxable corporation, a partnership. We've had questions about if you're a joint venture, can you claim this? Generally speaking, if you have paid wages, you're running payroll, you're eligible for this. If you have a business account number for payroll purposes, you can do this. And to qualify for this, you have to prove that you experienced a 15% drop in revenue in the month of March because of COVID-19 measures, or a 30% drop in revenue in April or May. And the interesting thing to note here is if you qualify for March, you will qualify for April. But we're now in the month of May, you actually have to reapply for the month of May to prove that you have a 30% drop in your revenue. And then another interesting note, as I mentioned, I have 4 doctors on my street, and this is a common topic for us for social distancing happy hour. I know that some doctors get draws from the hospital, and then you do your billings. So there's been some questions as to what do I use to prove my drop in revenue, and it's your billing that you would use to drop that you have a drop in revenue. Again, you should have a payroll number on March 15th and have paid some sort of wages either to yourself or to your staff. The amount of subsidies that you'll get will be based on what is eligible remuneration, what is the eligible salary amount. And in a very short summary, it is based on either 75% of what you actually paid, up to $847 a week, or the lesser of $847 a week, or 75% of the employee pre-crisis weekly remuneration, plus the employer's contribution to EI, CPP, QPP, QPIP, and then less anything that you're getting from the temporary wage subsidy, which we're going to talk about in the next slide. What's interesting is on the right-hand side of this slide, there are special rules for what we call non-arm's length employers. And what that generally refer to is owner managers. When you are, so for many of our members, it would be when it's your own medical professional corporation. When you do pay yourself a dividend and you sometimes pay yourself a salary. You may also have family members that you employ in your practice as well. The reason for the special rules is for owner managers, you do have the flexibility in how you pay yourself and how much you pay yourself. So there might be some planning where it involves, well, why don't I just pay myself a higher salary, you get a higher subsidies. So for that reason, the subsidies for non-arm's length for yourself as an employee and for family members that work in your practice will be based on what they call a baseline salary, which is actually what you paid in your payroll as a salary from January to March 15th of 2020. And you can only get a subsidy that's lesser of $847 a week or 75% of the pre-crisis weekly remuneration. The next wage subsidy, which is also popular, is called the temporary wage subsidies. So the qualification for this is slightly different than the CEWS that we've talked about. You don't actually have to prove that you have a drop in revenue to get the TWS, but you need to be a small business, which means the definition, what they're going to use is what we call a CCPC, a Canadian Controlled Private Corporation. And to qualify for that, yourself as a medical professional corporation, and or if you're in an associated group such as a partnership, the whole group should have taxable capital less than $15 million. And so I would advise you, if you are in a situation where you would question what your taxable capital is, do place a call with your accountant just to check for qualification for this. The other difference between this program and the CEWS that we just discussed, this isn't an actual check that they're going to send you. What they're going to do is they're going to give you 10% of the remuneration paid between March 18th and June 19th. And they're actually going to reduce what your payroll remittance would be to CRA when you run your payroll or when your accountant run payroll. The subsidies is a maximum of $1,375 per employee to a maximum of $25,000 per employer. And both subsidies will be taxable to the recipient corporation. On the next slide, we often get questions as to what do I qualify for. So we did a flow chart for this, but I know MD also have a very nice infographic on the website for this as well. So the key really is, do you have a payroll number? Are you in fact acting as an employer? And if so, did you experience a drop in revenue on the left-hand side of this? And if you do, you are very likely, have you paid yourself a salary in the first 3 months of 2020? If you do, you could apply to CEWS. If you haven't experienced a drop in revenue, then you're likely going to be applying to the temporary wage subsidy. Then are you a small business, or is your taxable capital less than $15 million? There are going to be situations where you may be able to apply to both. If you get both, whatever you get under the TWS, the temporary wage subsidy, is going to go to reduce the CEWS, which is the actual check that the government is going to pay to you. So besides these most popular wage programs, there's also a summer job program that is happening. The federal government is also going to provide employers a subsidy up to 100% of the hourly minimum wage, so they can hire summer students. So moving on to individual measures, one of the most popular benefits, and I know a lot of my friends and family actually apply to this, is the CERB. It's a Canada Emergency Response Benefit. And what it is, it's meant to give people a payment up to $2,000 for a 4-week period, up to 16 weeks, for workers who stop working or have a reduced income, earning less than $15,000, to actually get a payment from the federal government. And so either you are sick, quarantined, or taking care of somebody with COVID-19, or cannot work because of you need to take care of your children, you can apply for this. The way you apply for this is slightly different as well. If you do qualify for EI and you already applied to employment insurance, you would automatically be able to apply to the CERB program. But if you're self-employed or you don't qualify for EI, you would be applying to the CRA. So on the next slide, we also have a flow chart as to what you qualify for what. For the most part, I'm actually going to say, I'm not going to go through this in detail. If you are at least 15 years of age, eligible for EI, and have earned at least $5,000 of income in 2019, you are likely going to be able to apply to CERB and get the $2,000 a month. If you haven't earned an income or less than $5,000, then it goes to, is it because you were students? Perhaps you're secondary, post-secondary students. Then you can move on to apply to the Canada Emergency Student Benefit. The most recent announcement on this end is also the for low-income employees. So if your wages is under $1,000 for seasonal worker, you can also apply to this benefit as well. The emergency student benefits that we've just talked about, it's really meant for current post-secondary students, students who are attending in September of this year, or have graduated in December of 2019 and earn less than $1,000. This federal benefit is really meant for students who may have trouble getting into a summer job this year because of COVID-19, and it's $1,250 per month from May to August. And it's $2,000 if the student cares for someone or has somebody that cares for someone or has a disability. For students as well, there's also a new measure. It's called the Canada Student Service Grant. And what it is the federal government is investing about $291 million towards scholarships, fellowships, and grants for anybody that volunteers to fight against COVID-19. The grants will be anywhere from $1,000 to $5,000 that they could use towards their tuition. They will double that for eligible full-time students, up to $6,000 or $36,000 for part-time students, for people with a permanent disability or students who are dependent are also being doubled as well. Besides that, this is, again, a recent development. Our federal government has also announced a temporary salary top-up for low-income essential worker. And this particular measure is really aimed for support workers that are working at the front line, caring for seniors in long-term care facilities, those who earn less than $2,500, so $2,500 per month on a full-time basis, and that the territories and the provinces are deemed to be essential. So this program in some provinces are run through the province, and some are run through federally. So besides all these measures that are really looking to support income, there are other measures that are available for Canadians. The most recent one, and that makes my parents very, very happy, is the extra $300 of one-time tax-free payments for seniors that are eligible for OAS. And if the senior also is qualified for a guarantee investment supplement for GIS, they also get an additional $200. For those that are in retirement or getting a RIF age minimum, so if you have an RSP and you turn age 71, it converts into a RIF, which means you have to make minimum age withdrawals. So there's an age minimum with that. Because of the down markets in our market, we are reducing that to 25%. You will get a $400 one-time GST credit, as well as those who have children will get an extra $300 in Canada Child benefits. CRAs is also going to give us a break. So on the next slide, those who normally would be filing return, or right now it's May, you would have been late. Your personal return, which was usually due around the end of April, is now due June 1st. If you're self-employed, it is now, there's no change, it's June 15th. If you have a trust return, it is now due May 1st. For trust with other year-ends, it's June 1st. And for corporation, for your medical professional corporation, for example, it is now due June 1st, 2020. And the good news for payment extension, if you owe taxes, you can now defer those tax payments interest-free and penalty-free to September 1st, 2020. So moving on to the provincial program, this is actually interesting. In Ontario, this is specifically Ontario related. I know a lot of hospitals are talking about the advanced payment program. And what it is the Ontario government will top up your billings up to 70% of the average for the same period of last year. So physicians who are eligible for the advance payments will automatically receive these payments in May, June, and July. They will come in a remittance advice under Emerge Advice Payment COVID-19. If you want to opt out of this, you'll actually have to write to the government to opt out of this. And the way these advance payments work is they will look to recover whatever they pay to you now through future OHIP billing from November to March of 2020, and no interest is to be applied. So the interesting thing is, I know the conversation that a lot of people are having is this in fact a loan or is this an advance? But more interestingly to myself and my team and our team at ND as well, was how would this work in terms of government program? So I think within Ontario, a little bit of commentary to what the Ontario government did is smart, because this top up is 70%. If you were making no chargeable billings during this hour, probably because the OR is closed, or for whatever reason you don't have any chargeable activities, you can make up to 70% either from this top up. I know some hospitals are also doing top up for their surgeons as well, and still have a 30% reduction in your revenue, which technically will still qualify you for the CEWS program. But with anything, the devil is in the detail. So I do advise you to seek out an MD management advisor and your tax advisor as well. So with this, I'm going to pass it on to JS to talk about how the market's doing.
Thanks, Jennifer. Really rich and timely information. I know that when Lee did the survey, 2/3 of you mentioned that a drop of income was a key concern. And I know that Kim, who's my other colleague on the line, as part of her financial planning, I mean, she spent a lot of time taking that into consideration. The other topic, though, that did came up, and where 1/3 of you did mention some concern, is the market. So let's see. Looks like I may have lost control of the screen, but I mean, we'll see if this comes back or not in a few minutes. So I'll start with the markets. So what we, thanks, Becky. And so what we've had, and let's go back to the end of 2019. That looks like forever ago. But 2019 was an awesome year for equity market. Canada was up 20%, US close to 30%, foreign equities 15 to 20%, and even fixed income, good old bonds, were up 7%. So a well-diversified portfolio in 2019 would have returned in excess of 10 to 15%. So a really good year for investing. And 2020 really started in a good way, in a great fashion. Like from January 1st to February 19, markets were up, and there were starting to be a few signs that things may be changing. There were some news out of China, but the market did not start to pay attention to COVID until it hit Italy really, really hard. With all of that said, though, if you look from January 1st to April 30th, so that 4-month period, markets were down, and they were down quite a bit. But if you look at the ups and downs of the last 4 months, Canada was down about 14%, US about 10%. International equities were hurt a bit more, closer to the 20% mark. But again, interestingly, bonds did relatively well, hence the importance of having a well-diversified portfolio, and they were up about 5.4%. But as I've just implied, this is kind of the summary of the quarter. And if we look into the next slide and we see the behavior of the market over the last last 5 years, but I'll actually focus on the last 3 months, and you see the big dip at the end of the curve. This was one of the biggest drop ever over such a short period of time. So from February 19 to March 23rd, which was, I would say, the first market phase for COVID-19, equity markets dropped between about 20% in the US to about 35% in Canada. So very extreme. But the good news is that since then, markets have recovered somewhat. So they're not down minus 35, they're down minus 15. So not as bad, but down now nonetheless. So what we've had was a second phase from about March 23rd to about April 23rd, where we had, again, a very fast recovery. And the recovery did not occur because all of a sudden The pandemic was under control, and everything was looking up and up and up. The primary reason why the market did so well in that 1 month period is because of massive investments from central bankers and governments around the world to sustain the fixed income market, which provides liquidity. Liquidity is always good for equity markets. And from that on, we've had one of the most massive rally. Now we seem to be entering a phase of the market where it goes up a little, it goes down a little. I mean, the market is really trying to find its personality. I mean, some of you mentioned that one of the expectations that this may have a profound or permanent change on society, and there's no doubt that it will. But right now, the market is trying to really assess what will be changing for good, what may be changing partly, and what may stay exactly the same. So this is why we're a little bit in no man's land when we're looking at the equity markets right now, a bit up, a bit down. So if we move forward with some of our other themes that we do have, I don't want to repeat that too often. I mean, you've heard that before, but when markets go down, the natural human reaction, it's that fight or flight reaction. It's been studied. The same applies in finance. Market goes down. This is a pain. The natural reaction is to get out. And most of the time, I mean, this is well intentioned, but the challenge is not so much getting out. It's a challenge of coming back in. And this is the decision that most people miss. And what you see on this slide is an example from 2008, where you had investors who kind of closed their eyes and then woke up in 2020. You've got the investor who did get out of the market for at the bottom in kind of early 09, waited for a year for things to come back, and then reinvested, and the person that basically just stayed out of the market. Now, the difference between someone who stayed invested and someone who stayed in cash, I mean, is huge. I mean, you're looking at about almost $250,000 here. But the other one is the one that only got out of the market for 1 year. That doesn't look like a lot. But the thing is that when markets recover, they tend to recover quick and fast. So this is a big difference of about $100,000 in wealth. So I know right now, I mean, some of you may see the drop of income. You see the equity markets that kind of behave badly for 1 month. It kind of recuperated some of that, but it might still be a source of concern. And you're like, should I stay in the market? I mean, it depends on your personal financial circumstances, which Kim will cover in a little bit later. But generally speaking, if you're still a practicing physician and that things will come back to some sort of a normal in the future, staying invested most of the time is the best course of action. If we're moving forward, a few other themes that we've kind of looked into, and it's the labor market. Labor market was doing really, really well. And what we're seeing right now is that you've got 26 million of Americans are out of work, and about 7 million Canadians have applied for government support. So the positioning that we had at the start of the year was one where equities were set to grow because economies were set to grow. And I would say that our 18 to 24 month outlook, assuming that things stabilize, that there's potentially some sort of a cure coming up within that time period, still remains somewhat positive. But in the interim, the unemployment number, and we'll talk about earnings a little bit later, is starting to have a real impact on the economy and may have a bit more of a, I'm not going to call it a permanent, I'll call it a permanent short-term impact on the equity markets. That's one theme we've been looking at. Another theme that we've been looking into is also, I believe next might be energy. No, actually, so central banks. I've already talked about central bank. So the one reason why we see market going up so quick, so fast, was the investment from the central bank and governments, for the most part, working together. Now, you've seen volatility in the market in the last couple of days. Why? Because you have the US-China tension again. Governments are talking about, well, we're not sure we're going to reopen our borders. So there's a bit of, again, animosity politically that's feeding a bit of the uncertainty in the equity market. Moving along, when we look in Canada, oil and housing are two big themes that we're keeping a close eye on. I mean, most of you are probably aware of the significant drop in oil prices. Good news again, it did somewhat recover, but at about $25 a barrel, this is not sustainable and it is far from being profitable for Canadian producer. Housing is starting to be a bit of a source of concern as well. You could move on to the oil side, that's good. Housing is starting to be a bit of a source of a concern as well. But that is a trend that may be, it's hard to say how temporary that's going to be, but it will definitely have a bit of an impact. And part of that is because Canada did not suffer as much as other countries back in 2008. So on oil, I mean, we'll see a bit of stabilization, but the outlook for oil is not the greatest at this point in time. So that will definitely have an impact on the Canadian economy for the foreseeable future. If we move along. So looking ahead, I want to be the bearer of good news, and I'll say I'll be the bearer of mixed news. There can be different types of recovery. I mean, V-shape is what we all want, and we did see a sharp V from February 19 to about April 23rd. Not a full V, but now what we're starting to see is more maybe a bit of a U, and hopefully not an L shape. U is a bit of a slower, drawn-out recovery, and we may be getting into that because of unemployment, because of the time it may take to find a cure that will allow more permanent deconfining measure, and just things to come back to a normal. I'm not going to say the normal, but I'm going to say a normal. So V, unlikely. U, more probable. L, we're not there yet. And part of why we're seeing a bit of a U is part of the issue with earnings for many equities. So many companies have started to report earnings, and the news have been quite mixed. Yes, Facebook is doing okay. Yes, Apple is doing okay. Yeah, Netflix is doing okay. Yes, Google is doing okay. Amazon, like basically what we call the FANGs. And these are the stocks that have been doing very, very well for the last couple of years. And usually when you get a market downturn, what did good is what does bad. Not this time around. But the things that when Amazon announced their results, Amazon, if you look at it, it's a company that has never made a ton of money. They make a lot of revenue, but they don't make profit. And markets are starting to pay closer attention to that. Google, their income from publicity is going to be impacted by COVID-19. Facebook, they're launching a new video platform to try to get their revenues up, but they're not there yet. Apple, they're launching a new low-cost phone. So they're hoping to take back some of the business they've lost from the Android system over the years, especially in countries like China. So we do expect earnings, not just from these four companies, but on aggregate, to potentially be down as much as 20% over the next 12 months. So when market starts to pay attention, closer attention to these numbers, I mean, right now, some people are saying that the market has already fully priced that 20% drop in earnings, and I would say that's possible. But markets don't always react rationally. So we'll see how markets may react. But what I'm saying is that over the course of the next 3 to 9 months, we're likely to see a bit more volatility in the equity markets. So just in the interest of time, I will end my comments here, but I will be more than happy to take any questions that you may have during the Q&A session. So on that note, I'd now like it to turn over to my colleague, Kim Peterson.
Thank you, JF. That was great and wonderful information. So hello, everybody. I am here to talk to you about your personal financial planning. First of all, what is financial planning? To put it very simply, it's just a process of determining what your own personal goals are, putting a time frame on them, and figuring out what you need to achieve them. This process is ongoing. Some things we can put on autopilot, but we do need to monitor this. This is why we typically recommend that you review your plan at least once a year or anytime there's a material change. And those changes can be things like a career change, a marital status change, or if there happens to be a global pandemic that we're going through. On the next slide, you'll see a visual of the financial planning process. And this visual is in a circle, and that's not by accident. This represents the fact that the process is never actually complete. It's ongoing. We monitor areas such as goals, the strategies that you've implemented to get to these goals, your process or your progress towards these goals, and actually how you're working with either MD or your current advisor to get to those goals. Step 6 of this process actually even tells you, it reminds you that reviewing and adjusting is a normal part of this process. On the next slide, it will show you the areas of financial planning, and I'm going to go through each of these areas and give you tips on how to work through these areas during this COVID time. So based on the polls, I know that cash flow was an area of concern, and that will be discussed in financial management. We'll talk about cash flow, debt repayment, and accessing your emergency funds. We will touch on tax planning, give you some ideas of a couple of considerations you can look at. Investment planning, JF talked a little bit about that, but I will talk a little bit more about making sure that your assets are appropriate for you and your goals. Again, based on our polls, I know that retirement and long-term planning was a hot topic, so we will talk about that and what you need to do over the next few months to make sure that you are on track. And we will also talk about insurance and estate planning, which estate planning has actually been a bit of a hot topic to us, and that it goes over describing how you prepare documents to arrange for a transfer, an ideal transfer, and an efficient transfer of assets on your death. So let's start with debt. Next slide, please. There we go. So it's no secret that residents and physicians new into practice have heavy debt loads. If you're experiencing a reduction in income due to a reduction in your practice or someone in your household being impacted by a COVID layoff, our advice to you is apply for the government benefits that are available to you that Jennifer discussed. Then we want you to follow this rule. When paying down debt, pay down the highest interest debt first, then lower interest rate debts, and then finally the ones that charge 0%. Therefore, start with your credit cards, then move to your loans and your lines of credit. Avoid making payments to any lenders or companies that are giving you interest-free deferrals at this point in time. Things like the Canada Student Loan Program and the CRA. In certain cities, you can also defer paying your property taxes on your residential and commercial buildings. Year 4 residents are allowed to delay the hefty exam fee that happens in April, and they can delay it till August of this year, so take them up on that. And if you need to defer your mortgage payment, do this last, because there is an interest cost associated with that. Emergency funds. So if you do need to access emergency funds to cover costs, there is actually an ideal order in which you can access your cash. If you have cash in a bank account or a non-registered account, use this first. Next, consider borrowing. Interest rates are extremely low, and physicians typically have access to large sums of credit at rates below prime. If you need to access the funds that are invested, plan for this by considering that funds from your tax-free savings account can be withdrawn tax-free. Funds from your non-registered personal accounts may be subject to capital gains or capital losses. And funds from your RSPs and your RIFs will be subject to tax on withdrawal. Also remember that when you withdraw from your TFSA, you can recontribute that in the next calendar year. But if you withdraw from your RSP, that contribution room is lost. Next slide, please, Becky. Tax planning. So remember that selling investments to cover costs could have tax consequences. Make sure you know what these tax consequences are before you go ahead and sell any investments. Talk to your tax advisor, your MD advisor, or your other advisor and make sure that you know the consequences of this. For incorporated physicians, if your income is down, take a look at how much you're paying yourself. Does this amount still make sense? And is there any adjustments that need to be made there? This brings us directly into, Becky, if you move to the next slide, remuneration strategies. One of the opportunities of being a company owner and the employee is that you can adjust your remuneration as practice and personal income and expenses fluctuate. Many physicians, like yourselves, I'm sure, are faced with reduced practice income, but also we have reduced personal expenses. We're not able to attend sporting events and concerts, and we can't travel and we can't go shopping. So that's actually helped some people save money. If this is the case for you, you might not need to pay yourself as much or at all from your corporation, especially if your income is reduced and your overhead expenses are not. Altering your remuneration might also impact your qualification on some of the government programs. On to investments. So as you are aware, and JF mentioned, the markets are down. So there's a few things that we want to consider. First of all, if you manage your own investments, consider reallocating assets back to your target asset mix, meaning that you might need to manually move in assets between equities and fixed income or cash. When markets go up and down, different asset classes go up and down faster than others. So you might be left with more money in, say, income investments than you want right now. To realign to your target allocation, which is the asset mix that you want to hold, you'll need to sell some income investments and buy some equities. Note that when doing this in a non-registered account, you could trigger tax consequences. You could have capital gains or losses, and I'll talk about those in a minute. If, however, you hold managed funds, for example, at MD, then you don't need to make this manual adjustment. Your fund managers are doing it for you. Also, before we move from investments, as JF alluded to, if you are making contributions right now and you are able to continue with that, please keep them going. What you might want to do is consider your asset allocation and see if that's still where you want them to be invested in, but keep your contributions going if at all possible. Next, we'll talk about risk tolerance. So this might be a really good time to reevaluate your risk tolerance. When you're trying to determine your risk, it's actually pretty theoretical until something like this happens, and then you realize what you actually are willing to tolerate when it comes to market volatility. So if April didn't feel like you expected it to, consider revisiting your investment allocations to align to something you're a little more comfortable with. Start to develop a plan to realign your new risk tolerance with your current and future investments. This brings us to tax loss selling. So tax loss selling involves selling investments that have declined to deliberately trigger losses. These losses could be used to offset taxes that were already paid or that will need to be paid on capital gains. This cannot be done in registered accounts. If you're considering doing this in a corporate account, be sure to talk to your tax advisor or accountant about this first, as it could impact your capital dividend account. While tax loss selling is a tool in the tax toolbox, don't attempt to trigger any losses on your own without having a professional to explain exactly how it works and what the impacts could be. This brings us to retirement. So for those nearing retirement or considering looking ahead to retirement, if the impacts of the pandemic that we're currently in are worrying you, we can help rerun the numbers to determine if retirement still makes sense for you. If any adjustments need to be made, we can adjust the planning inputs and get you back on track. This part of financial planning is actually all about knowing your own personal facts so that you can make the best decision for your own personal circumstances. Remember that financial planning circle. Making adjustments as realities change is all part of this process. My best advice to you is to talk to your financial planner and make sure you know where you stand and what impacts this may have had on you personally. Next up is insurance, and this is an interesting topic because you may not be aware of how insurance can be used as well. If you're looking for access to cash, you might want to consider your insurance policies. Insurance can be a useful tool for a variety of cash flow issues, so don't forget to look at them carefully. You may have access to more tax-efficient emergency cash or benefits than you even realized. Some corporately owned policies allow you to borrow against the cash value inside the policy to tax-free. This all depends on the policy, but don't forget to consider them if you have them. And finally, we're going to talk about estates. So consider your estate plan. In fact, we've had a record number of your colleagues get in touch with our estate and trust advisors at MD over the past month. People are wanting to prepare their wills for the first time or update their wills. Our advice to you on this is that everyone needs a will. It should always be current, and your executor should know that they are your executor and where the will is. It is often an event that gives people the nudge to get a will. Usually it's buying a house or having a child, but in this case, it could be the pandemic. Remember that an effective estate plan outlines how you want your assets to be transferred and ensures that your beneficiaries' needs are met after you've passed away, and that this can be done in a tax-efficient manner. All right, so next up, we're going to, next slide, please, Becky. Yeah, this is our website where you can go for more information. All of these articles that are on the screen right now will be emailed to you, and they are also available on our public website. Next slide. Again, you can go also and look at Scotia's website for more details. This slide is actually one I just want to talk about quickly. We have something called What Do You Qualify For? It's an interactive tool that will help you determine exactly what you qualify for given your unique situation. This tool allows you to select your province, your career stage, and your pay structure, and will then tell you what you could qualify for under both the federal and provincial relief programs. It's a great tool, so please feel free to go have a look at it. And I will right now turn it back to Lee to see if we have any questions.
Thank you, Kim, JF, and Jennifer. That was timely and great information. We do have some questions, but we will open that up shortly. So in the meantime, please feel free to submit them in the chat now, and we will try to get to as many as we can. If we were not able to get to your question by the end of this, we will take note and follow up with you after the presentation. If your question was related to wondering what you qualify for, as Kim just mentioned, please request either request a virtual consultation, which will come up after this meeting, or visit md.ca and look at the tool, which is what do I qualify for. So we have had several questions come through already, so let's get to a few of those. First question comes up for JF. What do you expect after the pandemic financially to be prepared for?
So the way I'm reading that question, Lee, is what financial markets may look like and what may be different. So a few things on that is that, well, so what we'll say the same, and Kim talked to that. So around diversification, planning, asset allocation, all those principles will still be valid and will still be true. So that's not changing. But what might be different is the sector in which the equity market adds value. So in my comments, I talked about what is being referred as the FANGs, like Facebook, Amazon, Netflix, Google. Sure, there will be more movement toward digital economy. There's actually a new cloud ETF that's been launched recently to try to benefit from all the storage space that companies now need to store data and things like that. You may see warehouses may be doing a little bit better from a real estate perspective. So you'll still see similar sectors doing well, like technology, real estate, that kind of stuff. But what did well in real estate before and what may do well in real estate tomorrow might be very different things. But in terms of being prepared financially, Kim talked about the discipline of being investing, and I would definitely keep that. If you do have cash on the sidelines now or later, work with your financial advisor, people like Kim, to make sure that you have a plan for that. But I would say, I mean, these are the kind of thoughts that comes to mind, Lee, based on my understanding of the question.
Thank you, Jeff. Next question is for Jennifer. This is posed as, I'm incorporated in my first year of practice, working as a traveling locum general surgeon. What am I eligible to apply for in terms of financial support, provincial, federal?
Thank you, Lee. So first I have to research on what a local traveling locum surgeon is, and I Googled it. And so I think the criteria here is if you are incorporated, have you paid yourself a salary running through payroll, submitted payroll remittance from January to March 15th of 2020, because you have to have a baseline salary to qualify. And then you also need to be working in Canada. All of these programs does have a Canadian residency requirement. So the work that you're doing, is that being done in Canada or in the States or outside Canada? So they would likely only qualify billings and revenues and wages that are earned in Canada.
Okay, I'm going to ask you one more. Thank you, Jennifer. I'm going to ask you one more question here. Is CEWS subject to taxes? Is the advanced payment program subject to taxes?
So I'm going to say the SUS is subject to taxes. So that's the Canadian Emergency Wage Subsidy. It is taxable to the corporation or partnership or however you run your business. The APP is, so that we're still looking into, to be quite honest. It's that's why there's a debate as to, is this a loan or is it a some sort of advance payment? And so it's likely going to look like, it's likely going to be taxable, but not until later. And especially for the part, so the scenario that we did contemplate on is, what if there is no billings later on in the year? You're supposed to pay those in 5 equal payments with your OHIP billing later on in the year. So for an individual who doesn't have any more billings later on, what would that look like? That would look like a loan. But for people who are earning it out, it might look like an advance. So I think it's probably the tax implication of the APP is going to depend on your situation. If you are earning it out through OHIP, future OHIP billings, or if you are going to be repaying it.
Thank you, Jennifer. All right, the next question is for JF. Isn't it too early to say that we should keep invested when the market keeps going down and we have probably not reached the, it says nadir, but I'm assuming the bottom?
Yeah, so that goes back to a comment I was making in the presentation, is that timing the way down might be a little bit easier than trying to time the re-entry point in the market. And this is where most people lose value. So it's like, okay, I'm going to wait. Market may go down, and then you're off by 3, 6, 9, maybe 12 months. And as we saw on the slide, that was a $100,000 difference between someone who would have waited for a bottom and see things maybe coming back a little bit versus, you know what, I do have the time. I'm just going to kind of close my eyes and go through. So let's be clear. If you can time this perfectly, you'll be making way more money. The challenge, especially with the type of market that we have right now, is that this is not 100% economic driven. This is driven by an external event, which we may find a solution very quick, or we may not. So trying to time the, okay, we've reached bottom right now, for this time is more difficult than it's ever been for any other, let's call it down market. So for those reasons, I'd say it's not impossible, but it's so difficult that even for myself, which knowing I follow the market, I'm not even trying to do it because it seems very futile to me right now.
Always a challenge, and always why we work with specialists, whether that's why we go to doctors or why doctors come to us to figure these things out. Absolutely. So I have time for one last question, which has come in, and this one is for Jennifer, and then I think we'll have to call it there. So Jennifer, this question is: if you are taking Canadian Student Emergency Funds, can you still look for work and get some extra cash? This is for undergraduate students.
You could certainly look for work, and I think the criteria, let me just double check, is if you earn less than $2,000. So like any other program, if you earn sufficient wage and you are able to find work and earn income during this time, these programs really are meant for people who can't find a job or have a loss of income, but there is a requirement that if you earn too little income, that's substantially less. So for example, actually, my neighbor's daughter is usually work at a golf course. So she is getting called back, but likely the golfing season is going to be much shorter. So because she's earning reduced income, she would still qualify for the student benefit, and as well, she's qualifying for the CERB as well, but you can only get one or the other. So it really depends on if you do get a job, are you making significantly less than you would be?
Thank you very much, Jennifer and JF and Kim. Excellent answers, and again, very, very timely. So thank you very, very much. Also, I just wanted to make sure that I just cover up a few things here as we close out. If you still have questions, make sure that that you know that you do have options. Number one, you can reach out to your MD advisor. Or number two, when the session is over, you will see it pop up on the screen if you stay online to reserve a virtual strategy session to discuss your unique situation. I know there were some questions that came up were very unique to your situation, something we wouldn't answer on the webinar, but certainly we can help you out. And of course, you can review the recording of this webinar once we send it out. We will be sending it out. So again, a big thank you to our speakers this evening for joining us, and all of you attendees. Thank you, Dr. Jackson, Dr. Zabalatni, and their team for helping us organize this, this webinar. I feel like tonight was a really strong example of how working closely together with our partners enables MD to provide physicians like yourselves with timely and physician-focused financial information. We are so grateful for the opportunity to have shared COVID-19 emergency relief measures advice to all CAGS and OAGS. And with that, I will thank you again for attending tonight's webinar and wish you a good night. So have a great night, be safe, and be healthy.